Moving on to Section 179 expense. I love it. You love it. This is a tax provision that's going to benefit us as taxpayers. It allows businesses to deduct the full cost of certain qualifying assets in the year they are purchased or put into service rather than depreciating them over time. It was saying, hey, Nick, well, why don't you tell me about this? I'm telling you about it now. Instead of having to do all that funky depreciation stuff, we just buy a truck for $10,000 and depreciate the full amount. It's just essentially expensing it all in the first year. Why doesn't everyone do this? Well, we'll see. There's a lot of rules and limitations with this. Because again, this is a good thing. Section 179 expense, that's a good thing because you can take the full value. Now, money is worth more today than it is tomorrow. Even though tax rates will probably go up, pay the tax at some point in the future, right? That's the time value of money, all that good stuff, right? This is the purpose here is to encourage businesses to invest in new equipment and other assets by providing an immediate tax benefit. The IRS, they've got an angle with everything that they institute. So this is especially helpful for smaller businesses, as we will see. There are limitations and drawbacks to consider if this is going to be good or not for you. It's got immediate tax savings, increased cash flow. Now keep in mind that over the life of the asset, there's no difference in the total amount that is deductible when using Section 179 versus makers or any other method, or fully depreciating the amount. Now I know in those tables, for example, it didn't fully come out to $10,000. Don't worry about that. Just assume it does. That's just a little bit of a rounding error. This bonus depreciation, it's all about timing. Remember, time value money is essentially on every exam that we will have. Money is more worth to you today than it is tomorrow. That's the premise of it all. Diving into the benefits here again. So instead of taking that $10,000 truck and using makers and doing everything we talked about, mid-quarter, half year, all that good stuff, we are immediately deducting the full $10,000 of the truck. And the benefits here, you get immediate tax savings. So you can just take that deduction now instead of having to wait year over year and deal with that. Increased cash flow by reducing the amount of taxable income. You can get more cash flow because you are not paying as much tax upfront. And it's simple. Instead of having to worry and track the basis of all these assets over time, you can just say, all right, it's fully deducted now. I'm not having to keep a depreciation schedule. More simple accounting and bookkeeping. All right, what are the drawbacks? Well, the drawbacks also include the limitations on it. The drawbacks being, first off, there's a limitation on the types of assets that qualify. So only certain types of assets are eligible for this, such as machinery, equipment, and vehicles, as well as certain qualified real property. Qualified real property includes improvements to the interior of non-residential buildings, such as leasehold improvements, restaurant improvements, and retail improvements. Limits on the deduction. Well, there is a maximum amount that can be deducted annually. It's got an annual limit, changes year to year, just like many other amounts we've got throughout our course. They will be in the resources, and we update them as we need to as they change year to year for your particular exam. Now, reduction in future deductions, because you're deducting the full cost of an asset in the year it's purchased, you may not be able to take advantage of depreciation deductions in future year, and maybe the tax rates go up in future years. So maybe it would have been beneficial for you to not do this and to take the deduction in future years, but I mean, that takes tax planning and knowledge of the future, which none of us can see the future unless you're in the government, because you're creating the future, you're creating the laws, and they're the ones who knows what's going on. And it cannot create a loss. So doing this process, taking a full amount, Section 179 expensing, cannot be used to create or increase a net operating loss for the business. You can only get to zero. You can't go below that. You can't use this to create a loss and get some money back. The deduction is limited to the taxable income generated by the business in the current tax year, which means that if the deduction would result in negative taxable income, the excess cannot be used to offset other income or be carried forward to future years. So, as you see here, this may limit the immediate tax benefits for businesses with lower taxable incomes. Eligibility. All right, so kind of dealt with that a little bit more prior, but this is building on that much further. This is, again, going to allow us to expense cost of new or used tangible depreciable property placed into service during the tax year. We've got some limits and conditions. Well, it must be an asset that was purchased for use in a taxpayer's active trade or business. Passive investments or property used for personal purposes do not qualify for the deduction. Great example, I buy a new laptop to use in my CPA tutoring business, and I can, if I continue to meet these criteria, then I can immediately deduct that instead of depreciating that laptop over the full useful life. Purchased from an unrelated party. This has got to be something purchased from not a family member, no close relative. We're not here to manipulate the tax code. Hell yeah, at least I'm not. You can do what you want. Don't fight the IRS. So yeah, it's got to be an unrelated party. Tangible personal property. It's got to be tangible. We're not going to have real property such as land or buildings. Tangible personal property. And we went through what is defined as personal property. For sure, important to know there. Machinery, equipment, furniture. It could be a car, and that's another great example. You got a bakery service and you buy a car for it. That could, again, if we meet the other criteria, be immediately deductible. Well, it must be depreciable property. That's fair because this is bonus depreciation essentially. Must be depreciable, meaning that it has a useful life that can be spread over multiple years. Items with very short useful lives or those that are not expected to decline in value generally do not qualify. So land, not depreciable. And then let's say you've got a piece of equipment that is only meant to last a year. Well, you're going to expense that essentially. So that's why it wouldn't really apply there. For the dollar limitation, this section 179 imposes an annual dollar limitation. As we mentioned on the previous slide, the limit is adjusted for inflation and in subsequent years. The deduction is reduced dollar for the amount of qualifying property placed in service exceeding that phase-out threshold, as we mentioned, and we will see numerical examples to demonstrate this. Lastly, taxable income limitation. Section 179 cannot exceed the taxpayer taxable income from the active trade or business for the tax year, and any unused deduction can be carried forward to future tax years. Now, if you satisfy all these conditions, you can take advantage of the Section 179 deduction to expense the cost of qualifying property, which may provide significant tax savings and help to reduce the initial costs of acquiring assets for their business. One point I will note is that for our taxable income limitation, and can we carry this forward to future tax years or not, the previous slide mentioned how we cannot, whereas this slide mentions we can. And what is that discrepancy? Well, we cannot use the Section 179 expense going forward. We will then do normal depreciation for the remaining balance going forward. So in a way, you're not going to lose the value of it just because you can't take the full amount this year. You are going to just be able to do normal depreciation for that afterward. And we'll see examples of that as well. But let's say we've got a $100,000 asset, and for our limitations, you can only take $60,000 of it. So the remaining $40,000, you are going to have to depreciate that over the rest of its useful life. So that is the different treatment there. So you're not losing the benefit of the value of the asset to depreciate. You're just not able to then classify it as Section 179 expense. Classification is also super important no matter where we are in this exam. Yes, even if you are getting depreciation and Section 179 expense or just some sort of other expense, it's very important to classify these and put them on the correct lines in the tax form. That is something that can very much trick people up on the exam as well. All right, we got a first example here. A taxpayer purchased a commercial property for $25,000 and placed in service other tangible business assets that cost $120,000. Disregarding business income limitations and assuming that the annual 179 limit is $135,000, the maximum amount of cost recovery they can claim this year would be $120,000. And why is that? Well, under the election to expense certain depreciable assets, the taxpayer may expense the cost of depreciable assets up to the limitation. In this example, it's $135,000. That number is, again, just for example purposes. Therefore, only the cost of depreciable, tangible business assets can be expensed, which is $120,000. We see in this example, the purpose of this was to exclude the commercial property of $25,000. So that would not be eligible for 179. Now, yeah, there's a lot of other bonuses and benefits for something like commercial property, but 179 is more so for smaller businesses, helping them out, enabling them to get this full benefit in the current year. Time to dive into a big old example here dealing with our Section 179 expense dollar limitation, and we're going to deal with the phase-out threshold as well. So let's assume that the annual dollar limitation for a given year is $1,050,000. Again, this is subject to change. You need to memorize this for your exam. You won't be given it. You're going to have to memorize it. The phase-out threshold here is $2,620,000. What's the difference between the limitation and the phase-out threshold? We will see. We got ABC Company. It's a small business. It acquires and places into service the following qualifying assets in the same tax year. We got machinery A, B, and C. We see this. We got a total cost of qualifying assets of $1.7 million. Now, since the total cost of the qualifying assets of $1.7 million does not exceed the phase-out threshold, we're eligible for the full deduction up to $1,050,000. Now, we'll see down here, if you start to put into service assets over this amount, we start to get this $1 million, $1,050,000, God forbid I forget the 50,000, start to get reduced. The company decides to expense the entire cost of machinery A and machinery C under Section 179, which totals $1.1 million. However, because this deduction exceeds the annual dollar limitation, we can only claim Section 179 deduction of $1,050,000, as we saw back up here. The remaining $50,000 will be subject to regular depreciation rules, such as makers, over the appropriate recovery period, right? We're going to take what we can, cram it into that amount, the limitation that we're given year to year, and deduct that amount. Now, exceeding this phase out threshold does not disallow the full amount of the 179 deduction. However, it does reduce the maximum amount that we can deduct. For every dollar, the total cost of qualifying assets exceeds the phase out threshold, which in this case is $2,620,000. The maximum allowable deduction decreases by the same amount, so it's dollar for dollar. So in another example, building on this, and let's just say we changed that instead of the total cost of qualifying assets being 1.7, let's say it was $2.7 million of assets, which is $80,000 over the phase out threshold we see right here. The Section 179 deduction limit of $1,050,000 would be reduced by $80,000. So instead of being able to deduct the $1,050,000, we're now reducing it by 80, and as such, this amount is going to be $970,000 instead of the full $1,050,000. That's how the limitation and the phase out amounts work. All right, let's see this year over year. We've got a multi-year example. Let's assume a business purchases qualifying assets over a 3-year period, and in one of the years, the asset purchases exceed the annual limitation. Let's also assume the annual limit here is $1 million, and the business has enough taxable income to take the full deduction in each year. Meaning we're not going to be able to get a loss there because we know we can't take those. Here are the details of the assets. In year 1, we purchased asset A and asset B and placed them in service. We have in year 2 asset C and D, and then lastly in year 3 asset E. Now, year 1, the business purchases asset A and B for a total of $90,000. They elect to take the full Section 179 deduction for both assets. So that's it. Done. Nice and simple. Well under the limit, so the full $90,000, we're good to go. Now, the business purchases assets C and D for a total of $1,050,000. This is year 2. Since the annual Section 179 limit is $1 million, we can only deduct up to that limit, so we're stuck at the $1 million. The remaining $50,000 of the asset D's cost will be depreciated over the asset's useful life using the appropriate depreciation method, such as makers. Now here we're taking the full deduction for the asset of $30,000, and that's it. That's how we're going to treat that. So this is just not to be too complex, but this is just a great way to demonstrate what happens year to year. How are we dealing with all this? What happens if we go over the limit one year? And then also tying in our previous example, what happens dealing with that phase out amount. Over the 3-year period, the business has utilized the Section 179 bonus depreciation expense to immediately deduct a total of $1.12 million in asset costs. In year 2, when the asset purchases exceeded the limit, we were only able to deduct up to the limit and had to depreciate the remaining cost over the asset's useful life. Awesome. We are having a good time. We're powering forward. Keep going strong. You got this. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.